Welcome to Trading Day. I'm Roger Peterson. Thank you very much for joining us here. Let's get to some of the stories we're following in the BNN Bloomberg newsroom. Prime Minister Mark Carney says his support for U.S. military action in Iran came with regret, adding that the current conflict is another example of the failure of the international order. Speaking at a news conference in Sydney, Carney addressed about the need to prevent Iran from acquiring nuclear weapons, but says the U.S. and Israel acted without engaging the United Nations. SSR Mining is a top performer on the TSX today. It's up nearly 11%. The precious metals producer is selling its 80% ownership stake in the Copper mine in Turkey. The cash deal worth $1.5 billion US will see SSR sell the mine to one of Turkey's largest industrial companies. The miner plans to use the proceeds for reinvestment, capital returns, and growth initiatives. Shares of Abercrombie and Fitch are off today. They're about 4.6% right now. The apparel retailer warning there will be a greater tariff impact on profit as well as a slowdown in sales growth for the full year. Fourth quarter same-store sales also missed expectations, with growth in its Hollister brand failing to meet estimates. Quick look at the markets, and there's a bounce back today after yesterday's sell-off pretty much across the board. The TSX right now up by about 0.4%, and south of the border, similar situation, pretty much green everywhere you look. The Dow Jones, the NASDAQ, all up right now. There we go. Waiting for to see those numbers, but they're all having good days. Look at the S&P 500 up by 0.9 almost. Dow 0.67, NASDAQ 1.45. As geopolitical risks and uncertainty continue to impact markets, my next guest has some ideas for your portfolio. Let's discuss them now with Jerome Haas, portfolio manager at Lightwater Partners. Jerome, thanks very much for joining us. And I think the big one, I was reading this and I'm ready to go. I'm interested in this one. The banks. You're not a big one on the banks right now.
Well, I mean, the banks have had a fantastic run year to date, and certainly in 2025, they're priced for perfection right now. They traded about 14 times PE valuation, which is the top end of 10-year averages. And, you look at the estimates for the year, we're probably going to do 5 to 7% EPS growth, according to analyst estimates. So you're not going to get an increase in valuations from this level. If your upside's 5 to 7%, you look at the downside. If we move closer to normal valuations for the banking sector, say 10, 11 times, you're looking at 20, 25% downside from here. So 5 to 7% upside versus 20, 25% downside. I think it's a good time to be trimming some banks, especially after they had great and better than expected earnings last week.
And what are some of the potential headwinds that have you worried?
Well, I think the biggest one is CUSMA, which no one's really talking about. When we talk about the CUSMA renegotiations, everybody focuses on some of the protected sectors, and mainly the dairy and poultry. But the two biggest sectors in Canada that are protected are the telecom sector and the banking sector. And so if Trump starts rattling some chains and making some noise about the protection in the banking sector, I think it could have some serious implications for sector valuations.
Do you think, do you see the possibility of them opening up Canada to American banks?
Well, everything's going to be on the margin. We've seen what they've done with the dairy industry. It's very, very minimal. And there will be some concessions along that basis. It's not going to be dramatic, but it could take a knock on valuations. If we go from 14 times to 12 times, then that's a pretty big drop in the share price of the bank stocks.
And what other possibilities could it turn into headwinds quickly?
Well, yeah, there's what's been happening in the Middle East, clearly risk premium is rising. So as risk premium widens, it does have implications for business confidence. And so if business confidence is falling, the big drivers of the banks the last quarter were capital markets and wealth management. And so if business confidence has fallen, those sectors will suffer. On top of that, loan growth was already anemic. It's going to get slower with business confidence drops. And, I don't think that's fully priced in as well.
And with the business confidence, I guess, is the big concern the Middle East right now, or are there other issues that people should be paying an eye on? Putting an eye on?
The Middle East is the most obvious one right now, but I think the CUSMA negotiations coming up, in this quarter. There's the overall economy is still rather anemic, and there's concerns about inflation as well, whether or not that's under control.
Okay, and then the last one for the big banks, risk versus return. What are your concerns there?
Yeah, I just don't think the trade-off's very good at these levels. I mean, most investors have had a great run in the bank stocks. It's probably time to take some off the table and look to something else.
Okay, and what are the ones you're suggesting maybe people look at? Main Street, equity. Rental housing. It's not something that seems all that appealing, but you think there's some opportunities there.
Well, what's interesting is it's such a big issue for Canadians as a whole, but people don't think about it when it comes to investments. And Main Street is the largest provider of affordable rentals apartments in Western Canada. They've got about 19,000 apartments. And it's a very interesting time for them because there's still great demand for the affordable rentals, which is their bread and butter. I mean, their average rental is about $1,250, and you compare that to rents in Toronto, which I think when I last looked are $2,100. And we just think that there's ongoing demand for that. And it's one of the reasons why when you see the headlines that rental rates coming down across Canada, Main Street has had increases in their rental rates because there is this underlying demand that's not being tapped by the rest of the market. Their quarter came out 2 or 3 weeks ago, and funds from operation were up about 8% in the quarter, which is very good results in what are tough market conditions. But the other thing that's interesting about them is they're really loaded up with cash and liquidity. They've got about $800 million in liquidity, and that's fairly significant for a company that's only got a $1.7 billion market cap. And they're going to invest counter-cyclically because they're seeing great opportunities in the market to grow their business. And so they buy rundown apartment buildings, fix them up, and put them back in the market. And they can do so much, much cheaper than replacement or new builds. A new build's going to cost you $400,000 an apartment. They're doing it for $125,000, so that's why that they can afford to put out rents so much cheaper than a new build.
Do you see them bringing that money east, or are they're going to stay west with no desire to move this way?
I hope they never come east, frankly. They're primarily located in Alberta and in Saskatchewan. They do have some exposure to Manitoba, and then about 43% of their assets are in British Columbia. And the reason why we like the first 3 provinces because they don't have rent controls on them. BC does, but there's such a scarcity of housing and affordable housing in BC that they find it a very compelling market. And so that would be, those 4 provinces where we'll see the growth coming through.
And I just want to go back to the rental rates. They were rising, as you mentioned. What are they doing right? If everyone else appears to be struggling, what are they doing right in your eyes?
Well, look at, there's a new project for the federal Liberals. They're talking about Canada Builds Homes. So let's assume that they're able to build a home as efficiently as a private builder, which is a stretch by any standard. But let's just assume that it's going to cost them $400,000 to build new affordable rental apartments. Mm-hmm. So if you rent it, that's what it costs you to build it, you need to rent it out for $3,000 in order to justify what your expense was on that. So there's a lot of apartments in Toronto. There's 25,000 at last count condos that are unused because they're too expensive. No one's using them. So it's not a question of availability of assets. There are assets sitting unused in Toronto. It's a question of price. And the federal government's not going to be able to build them. And other builders can't do it for new builds as well. It's because they get their hands dirty. They buy rundown apartments and they fix them up. And it's a space where they don't really see a lot of competition because the pension funds don't want to get their hands dirty. Large institutions don't. And so they're able to buy at cheap rates, fix them up, and put them back in the market for renovated affordable housing. And to me, instead of us as taxpayers putting money into Canada Builds Homes, we should get the federal government to buy shares of Main Street Equity.
All right, well, we'll leave it on that note there, Jerome, but thank you very much for joining us.
Thanks for having me.
Jerome Haas is portfolio manager at Lightwater Partners. Coming up, we continue to track oil prices as tensions in the Middle East escalate. More on that after this. Oil prices remain volatile as the conflict in the Middle East enters its fifth day with the effective closure of the Strait of Hormuz, a critical global shipping route for oil and natural gas. Let's get perspective now from Randy Allenberger, Managing Director of Oil and Gas Equity Research at BMO Capital Markets. Randy, thanks very much for joining us today. Let's just talk about the price of oil right now. Last time I saw it was down slightly. What does that tell you after the surge we saw? Oh no, it's turned into the green. I mean, it's a bit all over the place, but it's a little more kind of hovering right now. What does that tell you about the situation?
Yeah, I think the market's trying to figure out whether or not the U.S.'s plan to escort tankers out of the Strait of Hormuz is going to relieve some of the pressures on supply. So right now, the strait is effectively completely shut down, but the United States government has said they are prepared to have a naval escort and send convoys of tankers through. So I think the market's trying to figure out whether or not that's going to work. I mean, if it does work, it'll alleviate some of the pressure on the oil market, and we might see oil prices retreat from current levels. If it doesn't work, either because practically they just can't get it together, or perhaps even there are some Iranian strikes on the convoy, I think you'll see the oil prices surge a fair bit higher.
I know you're not a military expert, but is that a realistic possibility? Do they have enough U.S. ships there to actually protect the amount of oil, the amount of tankers that will be going through? I think it's about 20 a day, isn't it?
Yeah, they've done it before. So, I mean, Iran has tried to close the strait before, and during previous, periods of time, if you got to go back 20 years or more, when Iran tried that, they did successfully have naval escorts keep the Strait of Hormuz open. So they can do it. They've done it in the past, but if the Iranians' missile capability has improved from what it was 20 years ago, I mean, it may be a little bit more difficult. But as you said, I'm not a military strategist. But I mean, in terms of the oil market, that's what the market's trying to assess.
Okay, and so if they can start getting the oil through, if that does work, we will likely see oil prices stabilize, maybe drop. What if they can't? What kind of a situation are we looking at?
Well, if they can't, I mean, I think we're going to see oil prices start to move significantly higher. I mean, we're talking about 20% of global oil supply moving through that market. We also are talking about a lot of natural gas, 20% of global LNG moving through that market. So I think we are going to see some higher prices if they can't reopen the strait. Right now, as I said, I think the market is assuming there is going to be some movement through the strait. But if they can't, I think we will see substantially higher prices.
Now, and they do have some alternate routes. They can go north, but they can't move anywhere near as much as they could through the strait, right?
That's correct. So we're talking about roughly 20 million barrels a day of oil and products moving through the strait versus a spare pipeline capacity of around 2.5 million barrels a day. So we just can't make up that amount of tanker shipment by using pipelines.
And what are some of the possible outcomes of this situation, and what might happen, and what is the best one to you and for people in the oil industry?
Well, I mean, this could go a number of different ways. I mean, the country could devolve into civil war, and that could have some lasting repercussions for the market. Maybe the conflict ends quickly. Maybe the Iranians simply capitulate, or maybe the Iranians get more aggressive in terms of their strikes on producing facilities in the Persian Gulf. So, I mean, it could go a number of different ways right now. And right now, as I said, I think the view of the oil market, if I was to look at those oil prices, I would say the oil market's reflecting a view that we're not going to see any facilities struck, say, in Saudi Arabia, where we have some significant damage. I think the oil market's assuming we will start to see oil trickle through the Strait of Hormuz. But as I said, it could go any variety of different ways. But certainly from our perspective, we think the risk is to the upside as far as oil prices are concerned.
Okay. And within Iran, have we heard any details about oil facilities there, if they've been struck, or have the U.S. and Israelis tried to avoid that? I know they're about 5% of oil production, but have they been damaged? Do we know?
Yeah, I mean, our understanding is Karg Island, which is their main export facility, has had some damage. The Iranians export about 1.5 million barrels a day of oil. So, if this conflict ended tomorrow, but we didn't have that Iranian oil in the market, the OPEC members can replace that amount of oil. So, that wouldn't be a disaster scenario for the market, even though obviously it's not a great scenario for Iran.
And I mean, a lot of that oil, from what I understand, was heading to China. If that oil suddenly was shut off, how does that shake things up for other oil-producing countries, China needing oil, and then would they be competing with the U.S. and other countries at that point?
Well, again, so, I mean, Iran's exports were only 1.5 million barrels a day. So that can be made up by, the Saudis increasing production by, 1 or 1.5 million barrels a day themselves. And so in terms of China accessing oil, they could continue to access oil from the Persian Gulf countries. It just wouldn't be coming from Iran any longer.
And there's no political issues with that if they turn to Saudi Arabia for oil?
No, I don't think so. I mean, I think really what you've seen is China and India taking advantage of discounted barrels on the market. So being able to buy cheaper Iranian barrels from that shadow fleet. They were doing the same thing with Russia. So really all it does is it increases the purchase cost for China and India. But in terms of the actual oil market and the price we see trading, it doesn't have any implications.
And you mentioned Russia. Would we see the possibility of increased shadow fleets from there?
It's a possibility. I mean, the U.S. has really clamped down on that. And so China and India have backed away from some of those Russian purchases. But again, they could just simply purchase more oil in the open market from other Persian Gulf countries. All
right. And then everything, the focus has been oil, and you mentioned natural gas, and that is a huge area. Qatar, we see 20% comes from there. What kind of an impact on natural gas, and what other options? Canada, can they play a role in that, or do we not have capacity?
So, what we've seen so far is a pretty significant increase in European natural gas prices. It hasn't filtered through to North American natural gas prices, but we are moving through the shoulder season here. But again, if the strait stayed closed and you started to continue to see very elevated prices in Europe, that would eventually start to push up prices in North America. In terms of Canada being able to fully participate in that, it's difficult. We just don't have as much access to the international market. We have LNG Canada off of the West Coast, which is nearing full capacity, but that's not really enough to fully integrate pricing into that international market.
Okay, Randy, thanks very much for joining us today. We appreciate the chat.
My pleasure.
Randy Allenberger is Managing Director of Oil and Gas Equity Research at BMO Capital Markets. Up next, MDA Space is trading higher after reporting a record fourth quarter revenue. We'll look into the numbers after the break. MDA Space is gaining today after reporting record revenues for the fourth quarter. We spoke to their CEO, Mike Greenley, earlier today, and he told us that MDA Space's backlog of $4 billion at the end of the last quarter would provide revenue visibility for the future.
It means that we have really high visibility in our revenue for 2026. So the large majority of our revenue this year was already in backlog in signed contracts that we have in the business. A very stable foundation for the company. Our backlog levels are up 7 times the level they were at when we went public 5 years ago. And so that gives us really good predictability in our revenue as we head into the year.
Now, for more on MDA Space's earnings and key drivers for the stock, joining us is David McFadgen, Managing Director, Institutional Research at ATB Cormark Capital Markets. And David, thanks very much for joining us.
Thanks for having me.
Okay, we heard about the backlog, $4 billion. It sounds good, but it missed on, it was 4.4, I think was the estimate.
Well, 4.4 was in the prior year, so this year was 4. We were expecting it to be down because the company hasn't announced any significant large contracts over the last 6 months. So that was not unexpected that the backlog would drop a little bit. But I think what's driving the stock today is a better than expected quarter. Revenue was up about 50%, EBITDA was up about 50%, both beating consensus estimates. And then the other thing that people were really focused in on was the pipeline. So the pipeline, MDA reported a pipeline today of $40 billion. The last time they updated their pipeline, it was $20 billion. So that's obviously up significantly. And so when people see that level of pipeline, they are quite excited about the stock.
And is it reason to be excited? Are you excited about that?
Absolutely. I think there's very high potential that they're going to convert a lot of that pipeline to the backlog. So the backlog are signed contracts that will eventually be reported to revenue. So I see tons of catalysts, contracts that they're bidding on. They're probably going to announce them this year. I think there's a very high probability that they will announce some contracts with the Canadian Armed Forces, or the Canadian government. You know, Canada came out with its industrial strategy, defense industrial strategy, and in that strategy, they want to rely on key Canadian companies, and MDA would be one of those.
And is that their best opportunity, or do you feel there's some bigger opportunities elsewhere?
There's, well, that would definitely be one of the bigger opportunities. There's potential for a Eutelsat OneWeb contract. Eutelsat's going to put up a new constellation for OneWeb. They have to be competitive. So MDA's in the running on that. They probably have to buy a European business to be more serious contender there. MDA is also part of a consortium in the U.S. That's bidding on a manned lunar terrain utility vehicle. That's a $4 billion U.S. contract, which could be announced at any time. So if that consortium wins, that'd obviously be quite substantial for MDA. And then also, MDA is in discussions with the Korean government about building a military constellation. So if MDA is able to secure that contract, that would be very significant for the company, because in the past, all the constellation awards have been for the commercial sector. So if it was able to win a military constellation with the Korean government, that would open up a whole other addressable market for the company, and the defense market would be multiples of the size of the commercial opportunity.
I want to ask about that, but I also just want to ask about the U.S. Any concerns with the tension between the U.S. and Canada being a factor on any of those contracts, or MDA being hurt by it?
No, I don't see it. MDA announced a deal or a contract with the U.S. military where it's going to be in a position to be able to bid on contracts for the Golden Dome. So the fact that they were green lighted to bid on that gives you an indication that there's not an issue here. Okay,
and then the balance between defense and commercial. Would you like to see that? I mean, obviously you both want to be growing, but is it good that they're focusing on defense, or seeming to focus more on defense right now, or should they have more of a balance?
Well, they're going after both the commercial and the defense market. What we're seeing now are space-based assets have dual use. So they're going to be used for commercial purposes, but they're also going to be used for military defense purposes. So I don't think you really want to say you just want to go after one or the other. You want to go after both. And more space-based assets are dual use.
All right. And we've talked mostly about the opportunities and everything. I just want to go back to the guidance, and you thought it would have been higher. What was the most disappointing number then that you would have liked to have seen bumped up?
Well, they gave guidance that was in line with the street. We're on the high end of the guidance range. It would have been nice to see the guidance up a little stronger, but I think the MDA is just being conservative. They have a track record when they issue guidance at the beginning of the year, then mid-year they raise guidance, and then when they finished the year, they beat the numbers. So if you look at 2024, they beat the numbers. If you look at 2025, they beat the numbers. So this is just a kind of a recurring pattern where they set the bar low and then they move it up throughout the year and then they eventually end up beating. So I think that's what's going to happen. So we're going to stay at 370 million of EBITDA. That's at the high end of the range. I'm comfortable with that. I'm absolutely convinced that they're going to be announcing some big contract awards this year, and one of them could be from the Canadian government with the Canadian Defense Industrial Strategy.
And I mean, with everything that's unfolding in Iran, is that a headwind, or are there other potential headwinds right now?
Well, I think, look, it's well known that NATO defense spending is increasing, and the target is to get to 50%, to get to 5% of GDP. And so I think MDA will be a beneficiary of increased defense spending. Okay, we'll wrap it up there, David. Thanks very much for joining us. Okay, thank you. David McFadgen is Managing Director, Institutional Research at ATB Cormark Capital Markets. Well, Ottawa has some big decisions to make in the coming months to replace Canada's aging submarines and fighter jets. We'll hear more on that from CTV's Jeremy Sherrill after the break. Shares of Capital Power are slipping. They're down about 2.35% after the power producer reported profit in its latest quarter that came in well below expectations. Despite the miss, revenue rose year over year and came in above estimates. The company says it's well equipped to meet rising demand and saw an expansion in electricity generation compared to the year before. Shares in George Weston are down about 4% after the company missed revenue and profit estimates in its latest quarter. The results were driven by a miss on revenue at Loblaw, as well as its real estate unit. Weston says the quarter was also impacted by some liabilities. On the upside, it expects earnings to increase from operating segments and says it will use excess cash to repurchase shares. More than a dozen Canadian and Australian pension giants have signed a first-of-its-kind agreement to increase investment between the countries. Under the deal, funds will cooperate to channel more pension capital into the two markets. The Australian funds say the move will enable both governments to remove policy barriers and improve the business environment for investment. Heading to the markets, and the TSX was stronger to start the day. It was in the green, still in the green now, but you can see it slipped a little bit. It's up by about 0.38%. South of the border, more green there, and a solid day across the board. S&P 500 up by 0.9, Dow by 0.6, and the NASDAQ by 1.5. Well, Foreign Affairs Minister Anita Anand delivered a keynote speech to the Ottawa Conference on Defense and Security this morning. For more on it, we're joined now by CTV's Jeremy Sherrill. Jeremy, thanks as always for joining us. What did she have to say this morning?
Yeah, Roger, look, the Foreign Affairs Minister delivering that keynote address this morning to that defense conference, and it stuck to kind of three themes, touching on priorities so far and things the Canadian government is continuing to address and focus on. She touched on, first, Canada's continuing support for Ukraine in that war, then elaborated on efforts to secure the Arctic and investments in infrastructure and a number of things in the Arctic, including the recent opening of a consulate there. The minister was in Nuuk, Greenland, for the opening of a consulate there. And thirdly, she touched on the situation in the Middle East, specifically reiterating what we have heard, in recent comments from the Prime Minister, that Canada's position is that it is important that Iran not be able to acquire nuclear capabilities, while at the same time, now it is important that all parties are making sure to adhere to the rules of international engagement. So really repeating there what we've heard from the Prime Minister. But the focus, the overarching focus of this conference is on Canada's defense spending specifically and reaching some of these key targets that have been established. A target of 2% spending of GDP on defense that has been established by NATO members for some time now. Canada is expected to meet that target as of this month and continues to be on track to do so. That is after significantly increasing defense spending and expediting the timeline to reach that target under the Carney government. It was originally expected that that wouldn't happen until 2032. But there was also a more ambitious target that was agreed upon by NATO members at the 2025 NATO summit in The Hague that is 5%. And the minister reiterated Canada's commitment to reaching that target by 2035. But it is expected that that would cost an extra over $33 billion in defense spending annually, Roger. So there's no question that the government and the Canadian Armed Forces will be looking to where to spend that money and how to do it in a smart way moving ahead.
And of course, two of the things are going to be spending money on the submarines and fighter jets. Anything new on that?
Yeah, absolutely. Those will be the two biggest ticket items, if you will. You know, a fleet of 12 submarines that Canada is looking to acquire and 88 fighter jets. When you look at the submarines, Canada is much closer to finalizing that deal. There are two proposals that have moved on to the final stage. March 2nd was the deadline to submit those proposals. There is a German offering and a South Korean offering. Canada is expected, we have learned, to make a decision on the subcontract by June. When it comes to the fighter jets, we are no closer to learning when Canada will make a decision. There's a review in place on the acquisition of those fighter jets. Canada has already committed to and paid for committed financially to 16 American-made F-35s. And there's a question now moving forward to reach their full fleet of 88, which is what they're looking to get to, whether they'll do so through the Lockheed Martin made F-35, or there is consideration now for a Swedish-made Gripen by the company Saab, which is an auto manufacturer. And there are a lot of questions about whether Canada will move forward with the American product or go with a different product. No closer to a decision on that front yet, Roger.
All right. Thank you for that update, Jeremy.
Yeah, of course, anytime.
CTV's Jeremy Sherrill. And let's take a look at the markets and see what's trending today on the TSX. Some of the leaders worth discussing right now. SSR Mining. It is up more than 11% right now. Of course, it's people reacting to the news. It's selling 80% of its stake in the Copper mine in Turkey for $1.5 billion US. MDA Space up as well. They had a good Q4 report, and see a rise of 6.7%, almost 7% right now on that profit and revenue beat. Shopify also having a good day, up 6%. It's been beaten up lately, so maybe people taking advantage of that. And Next Gen Energy had its Q4 results, and people were liking what they're seeing, up about 3.8, almost 3.9%. Then there's CAE. It is up. It signs a teaming agreement to pursue Canadian Patrol, the submarine project there, and it's up about 3.22%. And going the other way, some of the laggards, George Weston, not surprising on its Q4 profit and revenue miss, off by about 4.4%. Descartes Systems down as well, and they're off, not much right now, off by 1.9% roughly. And Capital Power down on their Q4 results. Obviously, maybe not as bad as some people thought. It's off by 2.65%. Well, Korean stocks recorded their worst two-day drop since the 2008 financial crisis. We'll dive deeper into the Asian markets after the break. South Korean stocks recorded their worst two-day drop since the 2008 financial crisis as the Iran conflict weighed on investor sentiment across the region. That has dragged down the Asian equity benchmark to its third day of losses. Bloomberg strategist Mark Cranfield discussed the market moves on The China Show.
We're entering a phase now where, especially for cross-asset traders, it's really just a question of trying to liquidate what you can, where there still may be some profits left in the trade. So everything here is vulnerable, which has had a really good run over the past few weeks or months. So obviously Korean equities have been outstanding for the past few weeks. So there's certainly going to be a lot of positions built up there. And we started to saw gold began to crack last night. It's doing okay today. but you could see there was a pretty decent sell-off overnight. So again, that was people reducing positions there. It's interesting you talk about the US dollar, because clearly coming into this period, people were mostly underweight the US dollar. There've been a lot of selling, a lot of positioning of traders being short the US dollar, so they have to reverse that pretty fast. And if you look across the currency space, one that's potentially vulnerable here is the Australian dollar. That's had a great run over the past several weeks. It hasn't really shown any big cracks yet, but clearly if this starts to spread where it just becomes a liquidation mode, where people just really trying to cash in anything they possibly can, then Korean stocks is just one. There's going to be several other assets which are going to come into play here. And even you see it to some extent in the Treasury market, because people came into this week actually pretty bullish on Treasuries. They're expecting the Federal Reserve to lower interest rates more. They weren't expecting a big spike in oil prices, and now people are getting pretty defensive on that market as well. So it's all being exaggerated because a lot of positioning as we came into this week was just simply the wrong way around.
Ruth Carson was talking about the clear big mover and winner is the dollar. How sustainable are these moves, Mark?
As long as you have a crisis building out the way it is, people will obviously gravitate towards the most liquid currency in the world, which is still the US dollar. It's got a lot of flaws. It's by no means a perfect asset by any means, and yet it is the most used currency in the world. It comes into play for most asset classes. A lot of things are priced in US dollars, whether it's commodities or bonds, or all kinds of things are using the US dollar. People are very comfortable with the fact that they can carry it anywhere in the world and get transactions done using that currency. So for the time being, there's no better alternative. It might not be everyone's favorite, but in a time of crisis, people want the US dollar because it has a track record of performing. If you look back at the global financial crisis, the US dollar was the best performing currency at that time. And there's a lot of question marks about others. When you look at the yen or the Swiss franc, which in the past have been havens, they're just not doing their job very well. So people are just gravitating back towards the US dollar.
At the same time, there's a story that's very well read this morning on the terminal, which is Goldman Sachs' David Solomon says he's being very surprised by the benign reaction that we're seeing in markets, what he considers to be benign reaction in financial markets to the conflict. Do you see that as well, that a sense of complacency at all? Of course, it's sort of a bit jarring when you think about how Asian equities are trading today.
Yeah, I guess he doesn't have a live feed of Korean stocks. I mean, maybe he should take a look at the Kospi. It doesn't look very benign to me, the reaction, or even the jumps in the oil market, the rapid reversal in bond markets as well. I think it's a little bit of. I think traders are taking that with a large pinch of salt. It doesn't look very benign. Maybe there's something he's looking at that I just can't see. But to me, there is anything but a benign reaction. Doesn't mean to say it can't go further. I mean, if this conflict in the Middle East lasts, let's say, worst case scenario, it lasts for a few months, then certainly financial markets could get into a much worse situation than we're seeing now. If it all peters out in a few days, of course, then markets can start to recover. But for the time being, there's already some very strong reactions, and we're only in the first week of the conflict, so it certainly has the chance to get even worse than it is now.
I can't imagine, Mark. What else is on your radar here? What are some of the next sort of pressure points to watch out for?
Well, one of the interesting things is we're in the first trading week of the month, which is a bit. It just tells you that we started the year pretty well. January and February, if you were in most asset classes, it would have been a pretty decent start. And it shows that people didn't really trim positions too much going into the end of February. So they're starting the month here with relatively big exposure to markets, been jolted by what's happening in the Middle East. So when you consider that it's happening so quickly in just this first week of the month, this could really get pretty nasty. We could have all asset classes are in play here, whether it's currencies, bonds, equities, commodities, everything is shaking at the same time. It's almost a situation of a genuine financial crisis, and yet we still haven't got into the quarter end yet. That pressure also will mount on people. Don't forget, Japanese companies, it's the quarter and the financial year end in Japan. That also has an impact on markets as well. The yen has been relatively stable to some extent. But as we get closer to the end of March, if markets are still in this kind of unstable situation, Japan really would have a big role to play, because people will have to do some serious book squaring up for the end of the Japanese year. So we've got a couple of weeks to go before that problem hits. But watch Japan. If you think it's bad now, things could get really exciting towards the end of the month if Japan is involved.
And that was Bloomberg strategist Mark Cranfield. Still ahead, today's market movers with Bloomberg Equities reporter Matthew Griffin. All right, so for some of the movers now south of the border, we are joined by Bloomberg Equities reporter Matthew Griffin. Matthew, thank you, as always, for joining us. And Chevron, why not? Let's add some more interesting news. Chevron selling off for a second straight day, even as crude rises.
Yes, well, Roger, thanks for having me on. And these moves in energy stocks have been really interesting over the past couple of days. Some of my colleagues had a story out on the Bloomberg about this. You've seen crude oil advancing yesterday, inching up again today, but a lot of prominent energy names falling, including Chevron. There are probably a few things going on here. For one thing, the energy sector has done incredibly well. S&P 500 energy stocks still up more than 20% this year. So investors may be kind of cashing in, especially if, another thing, there is a view that the Strait of Hormuz will not remain closed for long and there won't be a prolonged disruption in oil supply. So maybe a bit of a disconnect in how commodity and equity investors are reading the situation. But this will be a trade I'm going to keep watching, because again, this energy stock trade really isn't working right now, even as some of the other sectors continue the directions they've been heading because of the war. Like if you look at airlines, for example.
Yeah, but have airlines moved? They're still on downward trend?
Yeah, ended up just ticking lower yesterday and again today, most of them.
Yeah,
still taking it on the chin.
It's a tough one for them. All right, Dow is in the news today. What's going on with them?
Yes, shares of Dow up about 4.5%, and analysts are starting to weigh in on the implications of the war in the Middle East for chemical companies. Dow and a prominent peer, LyondellBasell, produce petrochemicals, notably ethylene and polyethylene. Of course, that is a mouthful, but they're chemicals made from the oil and gas that are being disrupted because of this conflict. You have oil prices rising, you have chemical supplies being disrupted, is what analysts are telling us. And so if you have supplies disrupted elsewhere in the world, you have the prices of chemicals rising, and that's good for the profit margins of these producers. It comes as they have been mired in a downturn. LyondellBasell just cut their dividend by 50% last month. There have been weak market conditions for chemical producers. Obviously, all of this could turn around quickly if the conflict comes to an end. But for now, investors looking to find places where the war affects the market, finding chemical companies a good place to hide.
All right, and a stock not affected by what's happening in the Middle East. It's affected by something else, Abercrombie and Fitch.
Yes, well, Roger, we get to talk more about U.S. policy, though, because Abercrombie & Fitch says they're taking a hit from the new 15% global tariff that Donald Trump has said he's going to put in effect. Of course, the tariff rate currently 10% around the world, but you had Treasury Secretary Scott Bessent, saying this morning it would likely go up to 15% this week. That is translating into a hit to Abercrombie's margins. They gave an outlook for first quarter sales growth and profit that missed estimates. You have the hit from tariffs. They say 290 basis point impact on their sales, and as well as the rollout of a new software program that they expect to hit the business's performance. That's all weighing on the stock today, down almost 5%.
Any other companies feeling similar effects from the tariffs, and talking about it?
You know, This is one of the first companies that we've really heard weigh in on the new 10% or maybe 15% tariffs. We just got that Supreme Court decision, I guess, less than 2 weeks ago now. Feels like longer because of everything that's happened, but we're really waiting to hear from the corporate world. I think this is one of the first big signals, but I would not be surprised as we get more consumer earnings to hear more on this in this vein.
All right, we've got to wrap it up there, Matthew. Thank you, as always, for joining us. Bloomberg's Matthew Griffin. And that wraps up this edition of Trading Day. Have yourself a great afternoon.